In this week's Property Insider Chat, Dr. Andrew Wilson and I discuss the latest rental market report from My Housing Market, and there's some interesting changing dynamics that he's going to unpack for us. We also discuss the latest inflation figures, retail spending, and auction results. So you're going to get a good idea of what's happening in our housing markets. By the way, if you want to keep up to date with what's happening in our housing markets, why not subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. Throughout 2023, our housing markets were a major focus for the media, weren't they? And it's not just the surprising strength of house prices in the face of rising interest rates, but also because Australia found itself in the throes of an unprecedented rental crisis, a situation that's shaping the housing landscape in a number of profound ways. The crisis, which has been characterised by skyrocketing rents and a supply that stubbornly lags behind demand, has been a pivotal issue for property investors, for policymakers, and most significantly for the millions of Australians grappling with housing affordability. So in today's Property Insider Chat, I want to unpack the latest rental market report from My Housing Market, and I'm going to ask Australia's leading housing economist, their chief economist, Dr. Andrew Wilson, how the latest monthly inflation figures and the recently released retail spending numbers may influence the Reserve Bank as it decides what to do with interest rates. Hi, Andrew.
Yes, good day, Michael. It is interesting that we all accept now how tough it is in the rental market. Tough for tenants, of course. It's a lot better circumstance for landlords who have plenty of competition for their properties and have seen skyrocketing rents obviously improve to some degree anyway, depending on individuals, their bottom line. But I think it's interesting, Michael, when we do look at Australia's circumstance as these markets with very low vacancy rates and skyrocketing rents, it's actually happening in other similar advanced economies. One of the common elements is undersupply. I'm talking about a number of those Western Europe jurisdictions, Ireland, the UK, the US, are all suffering from a lack of homes, and particularly new homes coming through. And of course, that's translating into similar rental markets that Australia is experiencing. But we have the latest data today, Michael. As you said, it's the November rent report, hot off the press. From My Housing Market. We're a little earlier this month because we've just come into the month, but it'll be a busy then and not so busy next few weeks. We're really seeing the same old every month in terms of rents, no real relief. Of course, there is some volatility, and we will see some volatility in rental markets coming up in the next month or two because, of course, it is the holiday season and there is less demand. And we typically see an easing in vacancy rates and higher rents. Now, the latest data is interesting in the sense that we're still seeing generally rents rising, Michael. And as I said, there can be some volatility in these numbers at this time of the year. But we're seeing just some very early signs, and I don't want to get ahead of myself here, of some easing in vacancy rates, which are still quite tight. But we've just seen starting to move, just not just November, but also the previous month or two, just some perhaps signs there that the supply of rental properties is starting to improve in rental markets. Now, as I said, I'm not calling anything here, but certainly there are just some early signs. Now, this may not be anything reflecting increased actual supply in terms of new building, but it may be that there are decisions being made now by tenants in terms of their property choices. So maybe we're not getting as much demand because of high rents. We're seeing different demand patterns starting to emerge. Potential tenants are postponing their decisions. We may be seeing a conglomeration of family units, choices pushing towards more affordable rentals and therefore not as much demand for the higher rent properties and areas. So maybe that's part of what's driving just those slightly higher vacancy rates. Maybe some shifts in demand. But we have discussed this, Michael, that with this rental crisis, which I think we can quite rightly characterise it as such, that there will be changes in social patterns and choices for properties, etc. Because people have got to live somewhere, Michael. So let's have a look at the data.
Before we do, if I could just say that even though the vacancy rates have crept up, they're still well below the equilibrium rate, which is somewhere probably around 2%, where there's enough properties for tenants. And on that basis, even though maybe vacancy rates are creeping up a bit, and I think you're right that it's people getting together rather than living on their own, people staying with their mum and dad a bit longer, those sort of decisions. but it still means that rents are going to go up because overall there's just not enough properties for tenants, but maybe not the huge growth. And we'll dig into how much especially apartment growth has been in our capital cities moving forward. So let's dig into it then. Let's see what has actually happened to rents.
Yeah, and look, you're right there, Michael. I mean, it's a horse and cart sort of which comes first scenario, because higher rents are changing these patterns of demand, but as rents ease, they will then reverse their patterns of demand. But as long as you're getting higher rents, it'll consolidate those. What perhaps we're seeing is changes in scenarios. So still tough times persist for tenants with the latest data over November, Michael, where most capital cities are reporting higher rents. But as I said, there's just some early signs of an easing in what nonetheless, and you're absolutely right, Michael, remain record low vacancy rates in most markets. So we're not calling anything near the sort of equilibrium mark. In fact, they're ridiculously below that still at the moment, but just some early signs. But as I said, maybe there's some social changes happening. So let's have a look at the data. Sydney had a big rise in house rents over November compared to October. Median rent now at $773 a week, Michael, which is a record. That's up 3% over the month. Melbourne rents were flat. Brisbane, which has been growing quite strongly recently, down by 4.4%. As I said, there can be some volatility in this data at this time of the year. Adelaide up 1.3%, Perth up 1.2%, Darwin up 0.7%, Canberra up 1.5%. So it was only the Brisbane market where we saw a fall in rents over the month, and we had Hobart and Melbourne where house rents were flat. Of course, the real story is what's happened over the past year. Sydney rents, house rents up 16.2%, Melbourne up 14%, Adelaide up 12.5%, Perth up 14%. This is remarkable results, Michael, over the past 12 months. And even Brisbane, with that 4% fall over the month, is still up 7.1%. Now, as I mentioned, vacancy rates shifted upwards in most of the major capitals. Vacancy rates up in Sydney, Melbourne, Brisbane and Adelaide, steady in Perth, a little lower in Hobart and Darwin and Canberra. But even though we're sort of saying those vacancy rates crept upwards, they're all below 1%, Michael,
yes,
except for Canberra, which is at 1%. So nobody's calling anything here. We're just saying, well, okay, just some trends and that might be shifts in demand and maybe some seasonal impacts. But it is what it is, and we have seen some of those signs, but they're still ridiculously low, under 1% everywhere except Canberra, which is quite remarkable. And when we look at unit rents, similar sort of pattern in unit rents, some volatility there. Sydney's unit rent actually fell by 2.7% over the month, down to $730 a week. Sydney still clearly has the highest rents for houses and units of all the capital cities. Melbourne was steady, Brisbane up 4.2%. So even though there was a shift downwards in Brisbane house rents over November, Brisbane unit rents were up sharply. Adelaide up 1.1%, Perth up again sharply 5%, and Hobart up 5.2%. They're smaller markets for unit rentals, Michael, so they can tend to be quite volatile. And the annual results, as you mentioned before, for units are still pretty spectacular, easing a little bit as we shift away from those low results of a year ago. But still, Sydney rents up 21.7% over the year, Melbourne up 22.2%, Brisbane up 23.8%. Top performer, Brisbane, Michael, for unit rents over the past year. Adelaide up 13.4%, and Perth also up sharply by 21.6% over the past year. This is quite unprecedented to see these changes. Yes, a lot of it was generated through the COVID lockdown, where we did see almost, well, no demand really for units in a sense, for various reasons. And so it's coming off a low base, particularly Melbourne and Sydney, but it's been really consolidated over the past year. And of course, a year ago, we weren't really being affected by COVID, but it does take time for these patterns to shift back to sort of more normal results, which is what we're seeing now. But vacancy rates are higher for units. And again, we saw a shift upwards in vacancy rates in the four major capitals, Brisbane, Melbourne, Sydney and Adelaide. And vacancy rates are above 1% now for units in most of the capital cities. Melbourne, which has always had the higher vacancy rates of the major capitals anyway, is now at 1.8%. As you mentioned, Michael, they're still well below 2%, so we're not really saying anything here. But certainly more of those signs that there's a consolidation in demand that's shifting or pushing vacancy rates a little higher. But something to keep an eye on. And as I said, that unit market has certainly eased with its vacancy rates and is now tracking a higher level in terms of vacancy rates than houses, but nonetheless still well below, as you said, that equilibrium rate.
This is unprecedented to get increases of rents in the 20% range.
Yes.
In fact, if you look back over the last decade, rents haven't kept up with inflation. So there is an element of catch up here. And while the media likes to pick on landlords and say they're being greedy, really the market drivers of supply and demand. And the bottom line for most mum and dad landlords, and remember 92% of the rental accommodation is supplied by ordinary Australians who only own one or at the most two properties, they're still grappling with higher mortgage rates, higher interest rates, uncertainty, government interference.
Yes.
So they're not raising rents because they're greedy. It's just to catch up for a short while.
Yeah, and it's the stupidity of the media that do promote these anti-landlord themes, because if this is what activates policy positions that are anti-landlord, which we've clearly seen over the past decade, and which has clearly landed us in this terrible position of not having enough rental properties and creating a lot of suffering with tenants, driven by an ignorant media. And the media gets more ignorant as the days pass, I think, Michael. And let's face it, they're just really chasing clickbait.
You're not talking about rental caps or rental freezes, Andrew.
Oh, no, that's a dead duck now, because that's failed overseas and they move on. All care, no responsibility. Yeah, what a joke in terms of what goes as housing market commentary. And what's concerning, perhaps, I don't know, is that some of the so-called quality financial media have made themselves look like complete fools in terms of their positions on the housing market over the past year, not just rental, but also buying market. But I think that the realisation is coming from governments, which is clearly logical. When you have an undersupply of something, well, you've got to create the environment to create more supply, to look after those people who are suffering with skyrocketing rents. And where's our undersupply? It's in private sector, landlord-owned properties. And we already have incentives, negative gearing, capital gains discounts, tax depreciation. I mean, they're already in play, Michael. So surely it makes a little bit of sense that governments should shrug off their ideological baggage, ignore the media, which I think most people do anyway today, and start accelerating or adding to some of those incentives just to get some more landlords and to have some fewer rents. Because as you said, landlords are prepared to take the risk to get into the market. So it is a frustrating environment in terms of the comments, but I do think we're sort of realising the mistakes that have been made in terms of the view of our private sector market, which does provide for our private sector rental market 40% of our housing. So let's look out perhaps for some common sense from policymakers in terms of giving investors a little bit more of an incentive to get into the market so we can take pressure off these terribly high rents. Also, we had some inflation numbers for October, Michael. Some good news here. Headline inflation was down from 5.6% to 4.9% over the month. Of course, that followed the rise, as I just discussed, from 5.2 to 5.6 over the previous month.
Andrew, that this had nothing to do with the rate rise 3-4 weeks ago, did it?
That's right. Yeah. We've got to also take some of this ABS data with a grain of salt, because it has been volatile, not just this series, but also other series of underlying economic data. It's just been a bit up and down, a bit bouncy, considering it's supposed to be seasonally adjusted. You're supposed to take away that volatility, but they're still suffering a little bit from the COVID experience in terms of their seasonal adjustment models. But nonetheless, this is good data, Michael. Let's not be too cynical about this. Underlying inflation was also low. And of course, underlying inflation is the key here. It was down to 5.3%. Now, even though we're saying, yeah, okay, that's great, it's down from 5.5 to 5.3%, it's still well ahead of the target, Michael, which is 2 to 3%. So we're tracking at double the target in terms of underlying inflation, and using underlying inflation as a model. And we saw that wages are rising at about 4% a year. We're sort of going backwards in terms of real wages growth, which is a real concern, of course. When we look at the contributors, again, it was housing, and that, of course, means rent, particularly, is contributing to higher inflation on a month-by-month base. Housing was up 6.1%, but it was lower than the contribution over the previous month. Food up 5.3%. It also was lower than its contribution over the previous 2 months, actually. And transport, which means fuel costs, they were up 5.9%. But again, the impact or the influence of fuel costs was actually lower than it's been for a couple of months, Michael, because we can all see that the price of petrol at the Bowser has fallen now below those $2 plus a litre results that we were seeing a month or so ago. So that's what's contributed to lower inflation, particularly the easing in fuel costs, and a little bit better news on housing, which we will discuss next week, Michael, which is the latest house building costs data off the My Housing Market Index, which is showing some good news there, or some better news in terms of house building costs And they're the two main contributors to the inflation model for the RBA is rent and house building costs. So, but still well ahead of the target range there at 2 to 3%, but a little lower, which is good. And we still see when we look at the charts for inflation that it's still very lumpy. It's still very high compared to the pre-COVID results. And look, it just means there's a lot of work to do to sort of get rid of that big hump of inflation that's still there in Australia. But some other key data that was released last week was retail sales. They were down by 0.2%, still up 1.2% compared to October last year. And that followed a big rise over September. I wouldn't be getting too excited about this in terms of it reflecting a weakening economy because we do have the November sales, which have just finished. I hope you took advantage of them, Michael. The data coming out, there was a few naysayers there who were trying to predict that the November sales would be down or something, the usual claptrap, but those with an agenda on rates. But we know that November's a very, very big month now, and the consumers wait for November, and it means that November really creates a trough in October as they're waiting, and a lot of the sales that were normally made for Christmas during December are now conducted in November. So we'll wait for those November sales. So not really much out of that. We have to wait and see what November brings us. But of course, our retail sales are still well ahead of pre-COVID scenario, and they're still tracking at around about the boom time rates of a year ago, which were driven by all those stimulus packages, of course. And we're still tracking at around about 40% higher than the pre-COVID levels. So anybody's trying to suggest that the trend's down and it's not good should look at the reality, the fact that we've had this remarkable boom in retail sales and that we're way ahead, even accounting for inflation and all that migration. That doesn't mean 40% increase. It's still very strong. We're buying. So let's wait for those November results.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process. It's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field.
So we had our first weekend of auction results, Michael, for December. It was quite a solid result, actually. So the number of sales, as we looked at last week, is really holding up. Very big numbers and certainly well ahead of when we had much higher clearance rates back in autumn and early winter. The number of sales is very strong, a little bit down on where it's been, obviously, for various reasons through October into November, but still very strong. And we had another big weekend of auctions, but clearance rates really held up, Michael. So the trend was quite positive. 859 auctions in Sydney, a little lower than the weekend before. But a higher clearance rate, 69.6% versus 68.3%, still tracking well ahead of a year ago, Michael, when the markets were reviving, both the clearance rate and the number of properties being auctioned. No surprise, because the market was still a little wary a year ago. Melbourne, bigger weekend, 1,071 auctions, Michael, and the clearance rate was higher in Melbourne, 65.2%. Another big weekend of auctions, and the clearance rates and the numbers of properties offered are again higher than a year ago. Brisbane, similar results the weekend before in terms of the number of auctions, but clearance rates a little higher. But we know those Brisbane clearance rates tend to be a less of a definitive reflection of the market compared to Melbourne, Sydney, Adelaide and Canberra. Big weekend in Adelaide, Michael, 133 auctions. Clearance rates are now certainly under the 80% plus benchmarks that we've been used to from Adelaide. 70.3% results, so certainly down on the weekend before. And 80 auctions in Canberra. Similar results to Canberra, a little bit higher than where it's been, but Canberra has been the underperformer. When we look at the trends, we can see that it's really just been an ease easing over the past month or so as we end the spring selling season in Melbourne and Sydney. Melbourne's actually holding up just at the moment compared to November, but of course we've only got 1 month worth of results in for December. Similarly, Brisbane just holding up, and Adelaide well below, as I mentioned before, those 80% results that it had consistently all the way through to November, as we saw very big numbers of auctions in Adelaide, providing more choices for buyers, more competition for sellers, and a little bit higher in Canberra this weekend compared to the November results. So I thought it was quite a steady result there, Michael. Of course, those results are all available on my LinkedIn account. On a Saturday night, 6:30, we send out the national headline results, and Michael, you send out on Sunday the regional breakdowns for Melbourne and Sydney, the national report.
Well, it's interesting because a lot of commentators thought as the year was finishing off, our housing markets would slow down. There was the scare that there was, well, forget the fixed rate cliff that never even happened, but more properties on the market, that talk about more distressed properties, the fact that having more vendors coming into the market would dampen enthusiasm and prices. That just hasn't occurred. The year's finishing off very strongly, isn't it?
It's finishing off in a very confident manner, I think, Michael. I think that's the point, that the confidence is still there. Of course, the end of the year always signals higher volumes of auction properties and lower clearance rates. It's a simple measure of supply and demand, but we haven't seen any sharp decline. And those that are using that as, again, predictions of doom and gloom for the housing market, which were wrong this year and have been wrong in every cycle so far, will only shift again to the what you wait till next year type of get out of jail narrative, that if it didn't crash this year, oh, well, it'll crash next year. But we're out getting ahead of ourselves, because we will have some discussion about the prospects for next year. I still think that we're going to have a positive year next year, but we'll discuss that in some depth going forward. But I think some better news perhaps this week. Well, some positive news. I'm not saying better news. Maybe some signs that there's just some relief for tenants, maybe, but there could be other factors at play here. And lower inflation. We don't know the real story on retail sales, and we won't get that data for a while. And auction markets holding up really well in terms of big numbers of properties being offered. And, you know, we've got 2 weekends left and it's all over.
Well, we'll be back next week and we'll talk about all the rest of the property news. Thanks for your time, Andrew.
Thanks, Michael.